In today's video, we'll take a look at what I see being the best FANG stock to buy right now and hold for the rest of the year. Let's get to it. So before we talk about the best one, let's quickly go over the others to see why they're not the best, going in order from worst to best. I should mention that I'm not particularly bearish on any of these names, as I think some of them are overdue for a run-up considering the long consolidation we've seen for most of the group for almost a year now, with some of the names peaking in September 2020. My least favorite of the names is Netflix. Netflix has been one of the best stocks to own, having gone up at an annualized 32% increase since it became public, making it one of the best performing stocks of all time. Unfortunately, I think its heyday has come and gone. As a stock, that is. I think the biggest issue facing Netflix is heavy competition now. Up until last year, their only real competitors were Hulu and Prime, whereas now there's Disney Plus, Peacock, Paramount Plus, Discovery, and a host of other smaller ones like Segi, Tubi, and others. This influx of competition showed in their last earnings report, where they reported slower growth than expected. Of course, they can reinvent themselves in some way, or perhaps get to the international level on a mass scale before the others, but until then, I remain neutral to bearish on the stock. Apple is the next one up. My main take on Apple is TA based. In the midst of a big rally in the stock market this year, Apple has traded sideways when it should have at least moved in tandem with the S&P, if not outperformed it. Although Apple had a good Q1 earnings, it wasn't as incredible as the other FANG names, Netflix aside. And even with such a good earnings report, the stock went nowhere. When we look at the chart, we can see Apple is sitting right at the first Fibonacci level, and that's with the market breaking all-time highs seemingly every other week. I can see Apple breaking down below this level and testing the second fib level. By that point, it would make sense for it to start a new uptrend, testing the all-time highs. However, I don't think it can make that entire move this year. I don't see new money going into Apple at the moment when most of the other FANGs, let alone the rest of the market, seems a much more enticing play. Coincidentally, by the way, the second fib level converges with this 5-year-long trend line, creating an even bigger case for a retest and also providing support though. At which point, that's when I would look to enter long Apple at those levels only, unless something changes fundamentally. Next up, we have Amazon. With Amazon, I do lean slightly to the bullish side. Amazon had a great earnings report for Q1. All analyst estimates were proven dead wrong. Where the analysts were looking for a 975 number on the EPS, Amazon crushed it and delivered a 1579 EPS, blowing analyst estimates out of the park. And this is why I place zero weight on analyst calls and estimates. They are dead wrong, and they merely adjust their buy and sell ratings after a stock has already made a big move. Their ratings are essentially lagging indicators, completely worthless. Back to Amazon. So the stock peaked on September 1st of last year and has traded within a very defined range since then. Just look at this rock solid support line at 2880 that was tested over and over, and big buying pressure came in for a bullish reversal every time. And it's been trading in this very clear and defined channel these past 9 months. For the bulls, I'd point to the moment this channel breaking out to the upside as the time to enter long. Unless we see a retesting the bottom end of the channel, which would be an even better time to enter long the stock. The bearish thesis on Amazon right now could be the fact that they have the highest PE at around 60, basically tied with Netflix. But the company keeps growing at such a fast pace for a $1 trillion+ company, so I wouldn't put too much emphasis on that. My second favorite of the FANG stocks right now is Facebook. The stock recently broke out of a 9-month high that was trading very similar to Amazon's channel. In Facebook's case, it was from about 245 to 300. The company posted a great ER and the stock blew past all-time highs on the news, but due to the recent selling pressure the Nasdaq saw these past couple of weeks, it was under some pressure, but recovered a few days later to make new all-time highs. Like the others, the company continues to grow. However, the stock has been held down due to a lot of political pressure. In fact, the only reason why this isn't my top pick is solely because of that reason. I know that Facebook has seen its share of political hurdles over the years and it's jumped through them every single time, but I just feel like one day it might catch up with them. It might be too much. What's unique with Facebook is that it kind of pisses off people on both sides of the aisle. The rhetoric from the right wing is the censorship one, and the rhetoric from the left wing is basically the opposite. For example, when their employees last year in summer 2020 were calling to ban Trump from the platform, I feel like they have to walk a very fine line, and one day they might make a colossal error and lose a lot of users or face real regulation from the government, as so far it's largely just been political theater. On top of this, another worry, although a lesser one, is that although Instagram is still growing, Facebook has been stalling in growth. This stock should have a forward PE in the 60s, which would put their stock price in the 600s, like Amazon and Netflix, or even greater. But instead, it's less than half of that, largely due to the political pressure they have to constantly face. And I believe the reason for this is because the market shares the same sentiment towards them as the one I just laid out. Its PE is literally the best out of all the FANG names, and we can even throw Microsoft in there. And yet it's still growing faster than just about any of the others. It's honestly pretty astonishing to see a company that's not even 20 years old flex this hard. And that's big props to their CEO, who's made such incredible strides ever since he departed from the human form.
But it is going to bother you because you're human, and I was human. I am human still. But I was just referring to myself in the past.
Alrighty then, so that gets us to my top pick. My absolute favorite big tech stock to own right now is Google. Alphabet, Google's parent company, has crushed all the other FANG names this year, being up 38% year to date, with Facebook coming in at second with 20%. The company reported an incredible $26 a share when Wall Street was calling for about $15. They absolutely crushed their last earnings. In fact, they've crushed analyst estimates ever since the pandemic started. It blows my mind how their forward PE is still under 30, yet Netflix is at 60. While the company has a somewhat similar business model as Facebook's, in that ad revenue is their largest source of revenue, it doesn't share as much scrutiny publicly as Facebook. This is the biggest reason why I choose Google over Facebook, because I actually really love the latter as a stock, but the political scrutiny can be too much to bear for risk-averse investors and swing traders. Technically speaking, Google's chart is as clean as any bull could ask for. It's been on a clear uptrend ever since, well, 2012 actually. If we look back at the past 12 months, the first fib level has only broken once, and also anytime the price has gapped up, it never retraced below it to fill the gap, both making a good technical case for the bulls. I feel that with the economy becoming super strong at the moment, with buying power for the consumer breaking records left and right, Google should continue to put up incredible numbers, and it will reflect in the stock price of the company. Alright guys, if you liked the video, hit the subscribe button, drop a like and a comment below if you have any questions. Peace out.